The administration got a lot of commitments from countries and companies to invest in the US. And that could really start as of this quarter, as of, I think, in September, potentially. And that could really change the course of the economy, because if you get big investments in the US, makes the economy a lot stronger, then rate cuts are not necessary so quickly. And that's a new path.
Hey everyone, this is your Market Outlook on CoinDesk. I'm Jenn Sanasie, and joining me today is FedWatch Advisors founder and chief investment officer, Ben Emons. Hey, Ben.
Hey, Jen. How are you? Good to see you again.
Doing well, thank you. It's great to see you as well. And it sounds like we're both doing better than the markets this week. I want to start here. How would you characterize crypto market sentiment today?
Yeah, it's a little frothy and a little, like nervous. I guess it's all to do with that. If you get such a good run, there's only a little bit that it takes to see some pullback, right? So people make this view of, okay, Powell will not say something about rate cuts and a kind of anxiety. Whatever he will say, it's going to be basically a reflection of the being of the Fed where they are now today. And for that reason, you don't actually have to pull back. It's more about, are the fundamentals changing such that makes your view about the asset class different? Well, you see two speeches now at Jackson Hole, Wyoming by both Waller and Bowman, who, by the way, are advocates of rate cuts. That they're also very pro-crypto in terms of payment systems, there's regulation, which is actually very bullish. I actually noted that Bitcoin didn't pull back so much today, somewhat up earlier when I was watching it versus the S&P. So I think people continue to pay attention to that, the view of the Fed and view of the administration, that it stays very pro-crypto and really wants to make this an asset class that people must own and can invest in and use for payment and all that, and make it like even more regulated, but in a good way. So I think in that sense, a positive sentiment, because the market feels a little toppy and a little frothy and a little anxious about what may or may not be said on Friday.
I want to talk about Friday in just a second, but let's talk about Bitcoin first here. Are there support and resistance zones you're watching, and what would a definitive break in either direction kind of signal for you as we look to September?
Well, as you remember a while back, we talked about the sky's the limit, and now Bitcoin can reach 100,000, and that looked kind of extreme at that moment.
Look at where we are now.
Exactly. So we continue. I think the high recently was something little over 125,000. So I do watch a bit of that zone. 100 to 125, because we kind of broke through 100 and kind of stayed above it and then reached that new high. So I think we're in this range for the time being, which is related to what rates are going to do. Because if we're going to get several rate cuts, I would assume that all the asset classes, including Bitcoin and crypto, will be supported by that as such, because it's just sensitive to what will happen to interest rates in general, because there's such an attention from the administration and the news cycle to interest rates. But then it's back to the fundamentals. And as I've just talked about, like, if there's such a support of regulatory to make crypto a really desirable asset, yeah, you can go higher, obviously. How high, I don't know. But I do know that we're right now, I think, in the zone of 100, 125, probably stay in there for a bit.
All right, let's talk about Friday. All eyes are watching the upcoming meeting in Jackson Hole. What would you constitute as a hawkish or dovish surprise on Friday?
So Powell had this view on price stability now for some time, and especially when you're in an environment where inflation picks up a bit, he's made comments to say that we need stable prices, otherwise the economy doesn't work for anyone. And if the economy doesn't work for anyone, then we're getting higher unemployment. So if you're going to put price stability first in that speech and then talk about labor, then the market will draw that line and say, okay, well, you focus more on inflation than on labor, and that's the disappointment. I really like to see you to talk upfront more about labor and the risks to labor, what's happening. And as such, the market will say, okay, that's great, because you're supporting rate reductions in the future to support labor. If you're going to talk about price stability, you may support a rate cut, but not sure when, how, what, right? It could be or could not be. So that could be the disappointment if it goes to the price stability argument. It's hard to say exactly. But one thing we have to watch carefully within the next sort of hour or so is that the minutes are released. There is a debate in there where Waller and Bowman make their case for rate cuts. And it's interesting to read there who else is in their camp who kind of sympathetic to that view, because that gives you a sense of the majority of the committee or not that's in favor for rate cuts, let's say near term, and by how much. And if that's the case, that's what Powell will reflect, because he's ultimately the center of the FOMC, so we reflect the middle, and that matters. So we'll see how these minutes look like. My take is it's going to be probably a speech that talks a lot about labor and transitions and the history and all this sort of thing. But I'm careful about if he talks too much about price stability, because that will be a negative to the market sentiment at this moment.
So if we hear about price stability, we may see risk assets like Bitcoin, ETH, other crypto assets maybe take a turn for the negative in the short term.
Yeah, that's how sensitive markets are to this rate cut speculations, I call it. Put that in the note today, it's a bit technical, but you can calculate it and notice that it's really sensitive currently. The whole sentiment is built up so much about this rate cut. Yeah, that if you say anything different about it, then yeah, that does affect sentiment. Therefore, people react and take, I guess, profit. And that's will be the reason why risk assets, including crypto, see a further blow off of the top, if you would say. How far that will go, who knows? Because if rate cuts were to happen, and it seems to be likely that it is, there'll also be money coming back in. People will be looking for an opportunity to buy the market again.
How many rate cuts do you anticipate we'll see by 2026?
Well, they have themselves, the Fed, penciled in about 4 into 2026. The market is priced about 5. And it's interesting that the market, where it is currently today, is not even at the lowest points on that dot plot that the Fed put out every quarter for 2026. So there's two people that think that interest rates should be closer to 2.5 next year, 2.5%. And the market is about a good 80 basis points above that in terms of its pricing. So there's more to go potentially, right? As in, if that camp in the Fed gets really control over the views about interest rates, we could see more rate cuts. So I do think they will happen. I think it's the same framework as before. They see inflation continue to slowly moderate over time, and it gives them room to cut, so to speak, because the rate between inflation and is wide enough that they can cut rates. But then it's also about how the economy evolves. There's one caveat here as a final point, is that the administration got a lot of commitment from countries and companies to invest in the US. And that could really start as of this quarter, as of, I think, in September, potentially. And that could really change the course of the economy, because if you get big investments in the US, it makes the economy a lot stronger. Then rate cuts are not necessary so quickly. And that's a new path that we have to talk about that. Don't know this yet, but I think for the time being, people are probably right. There's a few rate cuts coming over the course of the next 6 months.
Given either scenario you just pointed out there, it sounds like it could be a bullish year for risk assets in 2026. And I draw on a Bernstein report that was published and reported on yesterday that said the bull market could carry into 2027. I imagine what you've just pointed out there, both assets probably went into that prediction from Bernstein. I mean, like, do you see the interest rate cuts and more investment in the U.S. economy as kind of creating this bullish momentum that will take us further than we previously expected?
Yeah, I think that's right. And I think what it looks like is that the charts out there that we're in the 90s sort of episode again. And it makes to an extent sense, right? We back then too, I was actually just started working, and remember that Windows 98 was the new operating system, and the internet came online. You get this surge of investment after the productivity started to pick up in the economy, and that made the economy really strong with actually contained inflation. Core PCE in sort of from 1997 to 1999 was actually at 2% or below. And that's the sort of scenario we may see potentially again if we're getting all this AI spending turning actual more investment on top of any other investment, so that you're getting a surge of like money coming in that really drives the economy to a higher growth path, but possibly bringing actually prices down overall, as in you have high productivity, more supply, prices are lower, then you could actually see this bull market extend. And there's a chart out there that shows that we're sort of tracking what happened to the NASDAQ in the 90s. And if that's true, we're in for an accelerated upside, so to speak, meaning like we're going to see a big sprint higher. I think that has a lot to do with AI implementation and how it's all being really put into the economy and how it's invested. But that's maybe the next stage here. So you see some cases, right? Like certain particular stocks. I'm not a stock analyst, I won't mention it, but there are particular stocks out there that trade at huge multiples currently. It looks obviously overvalued, but what that really tells me is that this is a market anticipating the surge of investment of the AI coming into the economy.
It's interesting you bring up AI. For a long time when we looked at AI, we took a look at AI tokens as it pertains to crypto. But now we're looking a lot more at equities, AI equities. The AI token narrative has kind of fallen off a little bit. I would love to hear your perspective there. Do you think the focus is going to be more on stocks like Apple, Nvidia, that are looking at AI rather than these crypto AI plays?
It could be both, but it's notable that there's differences already developing in the market between what markets truly are pricing as the upside, which is, as you say, that's stocks that are really driven by AI. They either are spending a lot on AI or they are really driven by the AI process itself and therefore generate profitability. There's an AI index out there that's really well above the Max 7 index. And then you have other indices like that, like more software related companies that have actually lagged because some people see AI as a negative for certain particular software, right? They're either getting outcompeted or they're basically getting replaced by AI and therefore negative for the software companies. So there is something about the market making a divergence already within of looking at AI that is really the true profitability driver from here. And whether that's then stocks or crypto or even and fixed income, if you will, it's all about that really. That's what will really AI do to this economy in terms of how we are currently operating and how companies will continue to maintain high growth rates of profitability. And if they do, based on AI, then that's what really will be the upsides for the market, I think. That seems to be what's sort of implied from the differences between those indices I mentioned.
In your notes, you made a point about the 10-year Treasury yield being boxed in, but potentially ready to break out due to these anxieties that you and I have been talking about for the last 10 minutes or so. Unpack that a little bit more for me.
Yeah, so obviously on one hand is related to what the Fed will do next. So as you can tell from the graph, we cut rates last year. Initially yields went down, then they rose because if you cut rates in an economy that's strong, then rate cuts will add to stimulus to the economy or boost the economy. I think it's no different this time. We have an economy that actually shows some signs of reacceleration coming through different surveys and spending and retail spending. And as a result, if you cut rates, then likely yields are going to go potentially higher again, reflecting expectations for future growth. So that's very possible and very logical, I think, against how low we're going to go really with this funds rate. And that's the next debate here. So we cut rates a couple of times last year, but we're still above neutral. And people made a lot of case about the neutral rate is higher now. It's more like 3.5%, as opposed to the old neutral of 2.5%. So this Fed will be attuned to how quickly they're going to get to neutral, or where is this neutral rate? And that debate is happening already. And that may also be a little bit what Powell will talk about too on Friday, or at least touch on that. The neutral rate is ultimately with the economy is a total equilibrium between inflation and unemployment, right? So I think this is the next step here for the 10-year yield. So we'll cut rates, we're going to go a little higher, but then what is a neutral rate really? If the Fed is at neutral, then probably the 10-year will have not much room to rise further unless the economy really picks up. And that could well be, but that may not be initially the case.
And Ben, the last thing I'm going to ask you here is, as we head into September, I mean, we've talked about a few of these, but I want you to pick one. What's the single biggest risk or overlooked catalyst that you believe is not getting enough attention in the market right now?
Well, for one, it would be, I think, that investment in the U.S. It's a huge list of companies and countries. I'm actually quite bullish on that because I feel that and the way the tariff negotiations ultimately unfolded were actually such that the U.S. got mostly what it wanted. So President Trump is quite persuading in terms of getting, his way. I do think that he will go after these countries and companies, and then it actually starts to happen instead of just committing and talking about it and then sort of say, yeah, well, maybe one day, and then we're going to, kind of discount it. He's going to be out of office anyway, and then nothing happens. So I think the investment will happen. That's one catalyst. But the other catalyst, though, that is on the calendar, actually, is early September, and this is the next payroll report, because if we have this weakness that we saw in this previous report with all those revisions, what would that be actually the next report? get a new VLS, ahead of the VLS. Now, whatever happens there's a huge attention to that report because that's a critical report. It would basically solidify either that the Fed can cut faster, more, or not. And that sort of binary fact, it always has been surrounding that report, but it's more binary than ever, I think. So that would be very much on my radar. The next payroll report is early September.
It's always a pleasure chatting with you and hearing your insights. Thank you for joining me.
Thank you, Jen. It's great to be on.